Good morning. Welcome to our first GenCap Power Hour. I'm Scott Nasca, President of Generation Capital Management. I want to thank all of our viewers for taking the time to join in. We're trying to provide to our community and connections thoughtful and provoking conversations on topics that will have broad appeal for our audience. That's the reason why we've set up this GenCap Power Hour structure. We are very fortunate to have industry leaders within our local community, as well as nationally recognized experts that will be joining us over the next few sessions to continue to build upon the Power Hour structure. Please type in any questions you might have throughout the presentation, and we will try to answer as many as we can, time permitting, at the end of our session. I want to welcome GCM Vice President John Howe-Wemett to join in. John spearheads our financial planning division and is the vision behind our GenPowerment product offerings. John, can you expand a little bit on your background? GCM.
Hi, Scott. Thanks for having us do this together today. I'm really excited about it. So I'm the financial planner here at Generation Capital Management. I work very closely with you, with our clients, and we've recently launched our GenPowerment program as well, which is our subscription-based financial planning service, which means that folks can finally get financial planning guidance without having to have their investments with us here at Generation Capital Management. So we're really excited about that, and I've got my fingerprints all over all of that.
Great. Thanks, John. The format we're going to just be going through, the first live session is on a topic that it's always been a passion of mine and led me to the founding of Generation Capital Management. It's regarding investments and how to plan accordingly. I think this is, for our first session, this should be the ideal topic, considering all of what's going on in the markets right now, especially since the beginning of 2022. And 2022 has definitely been a difficult year for most investors, as we'll show in the graph that we're going to put up illustrates. It's just the year-to-date performance of the major three indices for U.S. markets, the S&P 500, the Dow Jones, as well as the NASDAQ. The Dow Jones, which is represented by the orange line, has the best return year to date, just a little over 7% negative, which as of Friday, so it doesn't take into account Monday's, low numbers that we had. But, as of end of Friday, August 19th, we had a minus 7.2% for the Dow Jones. S&P was second at minus 11.3, and the NASDAQ came in at the end at 18.9 negative percent. If you want to take a look at just through the chart through the year to date, John, as you can see, the first quarter, at the end of March, markets weren't down that much. We had a little drop at the end of February into March, and we had a nice little rally going through, leading up to the end of the first quarter. Second quarter is where we really experienced a lot of pain. As you can see, through the end of May and into beginning of June, where we hit our low points in all three indices. And then we have had a nice rally through since the middle of June all the way through the second week in August, as investors are a little more optimistic on the inflation front, GDP front, and what the Federal Reserve is going to say. So it's been a sort of a roller coaster so far. I'm not sure that we've not reached the bottom yet, but we'll we're taking what the markets give us. One thing that we did want to show as well is as we're talking about investments, a lot of talk is on the factor returns, and what factor returns are focusing on just certain sectors or aspects of the markets. And we've highlighted 6 different line charts here, and they're based off of certain characteristics of stocks or sectors, and everything is in relation to the S&P 500. So doesn't mean that they're positive returns, but in relation to what the broad market's doing, the orange line, which is the high dividend yield sector or factor, has performed the best. It's up 10% in relation to the S&P. Then it comes by value, which is the blue bar, and then low volatility, which is the light blue bar, small cap, which is the purple bar, and then all 4 of those have higher returns than investing in the S&P. So you can see that the high dividend, lower, higher, value in terms of structures and stability of companies and earnings, and small caps have all outperformed. And the two bottom ones are growth and momentum. Now, this is 2022. If you pulled up a chart from 2018 through 2021, you would see basically everything flipped over. Growth and momentum were leading the markets throughout that time frame. And so we've really seen sort of a reversion over the last 7-8 months, where as inflation has gone higher and interest rates are moving up, the higher risk or higher beta type investments, which have propelled the markets for through the last decade, have started to turn over at this point in time. So looking at all of this, John, one of the things I really want to talk about is with you is the importance of asset allocation. I know you talk to a lot of our clients or prospects out there. How do you go about counseling them when they start to see investment returns that we're showing, bond markets going higher, they see their values going down? What advice do you give them? How do you try and explain the importance of a longer term asset allocation structure?
Well, sure. That's a really great question. And I guess to kind of back up a little bit, we're talking about asset allocation in terms of the mix of the different types of assets in a portfolio. So stocks, bonds, kind of cash, and all of the little intermediary asset classes in between. And I guess that what I primarily focus on is making sure that the asset allocation is correct for where you are in terms of your risk tolerance, or kind of how it makes you feel when you see your portfolio go up and down. If you can't sleep at night, knowing that you might wake up in the morning and your portfolio is going to be down 1, 2, maybe even 5%, you might want a more conservative asset allocation. Then also your time horizon. How long do you have until you're going to, essentially use the money that you're intending to invest? And then also your liquidity need. We're focusing on making sure that the money that you're investing isn't something that you need to spend right now or within maybe the next 2 years or so, that you have other resources to do those things. So if we can kind of answer some questions, and we have some techniques that we have here at Generation Capital Management to help people at least understand their risk tolerance, all three of those aspects, to help kind of get them into the right asset allocation. We then talk about how it's important to maintain that asset allocation during there are kind of three pivotal times where we really look at adjusting asset allocation, kind of regardless of what's going on in the broader markets. So there's kind of the pre-retirement or accumulation phase, where we have a little bit more, we might have a little bit more of an aggressive allocation, as long as the client or the investor is comfortable with that. Then as we start to get a little bit closer to retirement, maybe 10 years out or so, we start dialing down the risk, because the client or the investor has less time to potentially make back any losses from the volatility, like what you were showing in that chart, Scott. And then, of course, and once a client is, or an investor is in retirement, that's an even more conservative portfolio, because the client is taking distributions from that portfolio. They're relying on that portfolio to live. During our financial planning sessions, we talk about how much they're spending, how much of that spending is coming from Social Security or other income sources versus the portfolio. So we have a very particular drawdown rate on that portfolio. And of course, we're trying to manage return and availability of funds, because the liquidity need is high. So taking all of that into consideration, we try to make sure that we're in the correct asset allocation for where the client is in their life. And we kind of, it sounds tough, but we kind of say, sometimes you got to ride the waves. And we've had a lot of up waves in the past couple of years, and now we're kind of seeing some down waves and some points where clients and investors are really having to test their mettle. But this is where these types of times are where proper asset allocation really sings.
Yeah, and it's a great point there. And traditionally, historically, when stock markets are as volatile as they are right now, you usually get some comfort from the bond market,
Sure.
as a diversification, because it's, it tends not to move in the same direction or velocity as stocks. And it does provide some diversification benefits. Now, as I say that, 2022 is not proving me right in this at all, whereas the bond market has been just as volatile, in some ways, even more volatile than stocks this year. So you have not gotten any type of comfort or diversification benefit by having an allocation to bonds versus stocks. A traditional 60-40 allocation, stocks versus bonds, was still down over 10%. So you're not getting really any of the diversification benefits from the bonds. So, what we have up here is just over the last 12 months, the bond market returns. The black line is the 2-year Treasury. So we're just pulling 4 different Treasury rates. We've got a 2-year, we've got the 5-year, which is measured by the orange, and then we have the 10-year, which is measured by the blue, and the green is the 30-year Treasury bond. These are all the bond measured by their yields. So you can see over the last 12 months, the dramatic shifts upward within the bond yields themselves. Now, the biggest dramatic changes are on the shorter end of the market, which is represented by the black and the orange lines, the 2 and the 5-year. You can see when we first started 12 months ago, the 2-year was, not even at 50 basis points in terms of yield. And now what we have right now is the 2-year as of, obviously the Friday the 19th, was up over 3.25%, a significant move in terms of direction and yields. The 5-year was up next. And then you see the blue and the green lines didn't have as much moves, but they still do have a significant negative rate of return because their durations and maturities are longer and they're more sensitive to interest rates. But what we want to see right here is, as I'm talking about, the 2-year and the 5-year are now above the 5 and above the 10 and the 30-year, especially the 2-year right now. If you look at the black line, it's above the green and the blue lines. So what that means is that the shorter term rates are higher than longer term rates. And if you look at that in terms of a curve, it's called an inversion. And we do have on the next slide here, which it shows the spread between the 10-year Treasury and the 2-year Treasury. And this, once again, is over the last 12 months. And you can see, for the longest time, the 10-year had a higher rate of return or higher yield than the 2-year. That's normal under economic growth situations. The economy is moving along fine. You should be having higher yields the longer you go out in terms of bond yields, in terms of maturity structures. And usually what happens is when we start to see that inverter coming down, it means that shorter term rates are rising faster than longer term rates. And what has happened is the Federal Reserve has raised rates 4 times this year so far, and 25 basis points in March, 50 basis points in May, and then 275 basis points moves in June and July, because they're really concerned about inflation. Inflation is really crippling the consumer right now. And so we've seen a major move in the short end of the curve, where rates are going up much faster than the longer end. And unfortunately, when we see these types of inversions where we see it below the 0 level there and into negative territory, that usually foretells a recession coming through. And some people have said that we're already in a recession. There's back and forth in terms of the true definition, but the curve doesn't lie and the spread doesn't lie. There's definitely extreme pressure being put on the economy right now and in the future, because interest rates are a lot higher on the shorter end than they were on the longer end. So, just taking a look at that, the Fed is really in a box, because they're raising rates right into an economic slowdown. And we haven't even started to talk about the impact that quantitative tightening is going to have that will be fully implemented in September. That's where they're draining liquidity out of the system. For the longest time, you heard the term QE, or quantitative easing. This is when the Fed was buying treasuries and buying mortgage-backed securities, really flooding the system with liquidity, which was providing, basically a sugar high for all risk markets. So what's going to happen when they start to peel it back? You're going to see the reverse of that. And I think the market's already factoring that in. John, one of the things I really want to talk about is, looking at this, and I know we're showing up just as a situation where everything isn't really working at this point in time. Stocks and bonds, you're not getting the diversification benefits. I mean, cash is one of the best holders at this point in time. But longer term, that's probably not the best play to make. I mean, how do you talk to the clients about staying the course and keep contributing to their overall investment plan, especially when they look at their statements and they see their money in their portfolios continuing to go down?
Yeah, another great question. So one of the things that I like to say, and it's kind of a well-worn track in the record at this point, but I like to say, when markets are down, things are on sale. So it's sort of a buying opportunity. If you're investing in your employer-sponsored retirement plan, if you're making regular contributions, you're doing the right thing. The right thing in good markets is the same thing as the right thing in down markets in terms of personal financial planning. We might make little tweaks, but overall, it still makes sense to be contributing to your employer-sponsored retirement plan. If anything, it might make even more sense than usual because things are on sale. We're taking advantage of the low end of the concept called dollar cost averaging. So what I try to remind clients is, well, when your investments are performing well, especially in your employer-sponsored retirement plan, like your 401k, 403b, 457, when they're performing well, you continue to keep ratcheting up the value of each share of those funds that you're buying within that employer-sponsored retirement plan. So things are getting more and more expensive. Well, as you see the value of your account go down, that means that each share of whatever investments you're utilizing becomes less expensive for you to then buy. So you're making the same contributions to your employer-sponsored retirement plan, and it's buying you more shares of that particular fund. So then, of course, when we buy more shares and the market starts to then go back up, we'll hopefully see a greater amplification of return. We'll start to see that compounding happen a little bit more dramatically, if you will, especially if we have these protracted or longer time periods where we have kind of lower returns or kind of stagnant returns. And then we come out and we start to see enhanced returns. You're going to experience that more quickly. It's going to feel better for you in the long term. So I always recommend, if you're having questions or having anxieties, think about it from a logical standpoint. Try to be as logical as possible and do research too. Because you're not the only person who's feeling these things. And chances are the reactions that you're having, other people are having as well. So learn what disciplined investors do. Talk to professionals. Talk to people like us, financial planners. Our clients tend to reach out to us, or we reach out to them when markets are a little bit shaky. And I would say, Scott, you would probably agree that most of the clients that have conversations with us when the markets are kind of shaky, they walk away feeling better and knowing what the game plan is. And, we kind of instill that in them as we go along. Every time we meet with them and kind of every time that we talk to them, we remind them what the game plan is.
Yeah, that's right. I mean, communication is key, especially when markets are volatile as they are. I think our clients appreciate that we stay in touch, that they understand our methodologies and how we're attacking the markets in its difficult times. No question about it. Nobody likes to see their portfolio values go down. That's always a difficult time for them. But our clients have been with us. Generation Capital has been around for almost 20 years. Our clients many of our clients have been around with us since many of the uncertainties and volatility that's been taking place, whether it be through 2007 and 2009, which was, I think, one of the worst times in terms of financial markets, where we had the banks potentially imploding and a lot of companies going under. And then you also have just, looking through the 2018, when, fourth quarter of 2018, when the markets went down 20% because the Fed started to raise rates. Yep. And then in 2020, we had the COVID pandemic. So there's no question about that. We've seen our share of volatility.
Yeah.
But as long as there's a process in place and it's well understood and communicated to our clients, they know that we're looking out for their best interests. So, number one, the big thing that we want to focus on, when we're explaining to the clients, John mentioned a good point of staying the course, making sure that you continue to invest in the right allocations. It's a great piece of advice for people who are do-it-yourselfers working in the 401k landscape and trying to save yourself on retirement plans. We tend to do things a little differently, obviously because we study the markets. We're historians. We're knowledgeable in terms of what the markets have. So we tend to look at the markets themselves and see opportunities or areas that we feel might not be the best place. And so we're going to modify and alter our portfolios, whether it being taking more risk or taking less risk in the portfolios based on where we are in the market conditions. One of the things I want to point out is we have a chart here. It's the last one that we're going to show, which is really the asset class returns. And it's from 2007 through June 30th of 2022. So the year-to-date number. And it's color-coded based off of representations. If you look at the legend down at the bottom, you can see representation of various asset classes, orange being the large cap stocks, blue small cap stocks. We have international developed stocks in black, emerging markets. We've got real estate in red, high yield bonds, which are in green. I'm sorry, high grade bonds, which are in green, high yield bonds, which are brown, and then cash. And then the gray one is the asset allocation, which is roughly a combination of stocks and bonds, roughly about a 60-40 mix stocks to bonds. Point that I want to stress, and I think this is something that John talked about, is, if you look at every year, what's the first thing that you see? Well, the same types of investments are not the top performers every year. Absolutely not. In a lot of situations, the best performer tends to be the worst performer or one of the bottom performers in future years. And this, we've used this time frame because it doesn't encapsulate the good times and the bad. So we're not just cherry picking, this is the best times of stocks. We've got times where in 2008 and 2009, you can take a look at in 2008, for instance, the best return was 5.2% and the worst return was minus 53%, which was in emerging markets. So, it pays to diversify. It pays to have an overall investment plan because, if you look, the best performing sector over the full time was orange, which is the large cap stocks. And if you look at that, large cap stocks were the top performer in only 1 year, which is 2019. Now you got real estate, which is up there, 5 or 6 times over the time frame as top performing, but that only had a return that was midpoint, their overall return for the full time frame. So if you're trying to chase returns and invest in just one specific asset class, your timing could be totally off. And that's why it's important to have representation in many of these different sectors based off of your risk tolerance, your time horizon, your goals and objectives. You should have representation in many of these various sectors because they do perform differently depending on the market environments. So it makes sense to have representation. And we use something like this ourselves because, we look for probabilities. We're an opportunistic manager. We look at what the markets provide us and we take advantage of it. And so we'll over allocate in certain areas that we feel are going to do well based on the economic cycle. But John, I just want to segment back to you again. You talked about anxiety and you talked about clients, the concerns that they have. How do you recommend keeping their emotions in check? I mean, what's the, what advice do you give, or what counseling do you give, or what therapy do you provide in some ways to have people make sure they stay the course? And what is the financial plan? How is that a really good map for them to make sure that they understand that, hey, let's look at where you are at the end and never mind where we are, at one point in time on the map?
Sure. Yeah. That's a really perfect way of asking that, because when I work with clients, I do focus on the emotional aspect of what they're going through. when I was working my way through my master's program in personal financial planning. We studied financial therapy and learned about money scripts, which are essentially the ideas that you carry with you in terms of your experiences with money and how those experiences simultaneously shape the next decisions that you make. And investing in general is a very emotional thing. Money is an incredibly emotional thing that we interact with on a daily basis. So the struggle is primarily in keeping our emotions in check. If you think about the way that you feel when you have a bad market, it's very visceral for you. It's very, I don't want to look at my account balances, or I don't want to, deal with my asset allocation or things like that. On the other side, you might not realize it because it's a better feeling, but it's also an incredibly emotional feeling when we have positive markets, when we're having positive returns. You're excited. You don't necessarily want to change anything because you feel like it's been working for you, even if you could be doing it better, or you could have a little bit better risk management. That's not a concern for you because you're kind of fueled by this mania of, hey, our investments just keep going up. It feels good. So there's a whole bunch of emotion that's going on. The best way that I can recommend, so of course, when we're making our own investment decisions in our retirement accounts, if we have investment accounts that we're handling ourselves, we do tend to make emotional decisions. The truth is that there's just not room in investing for emotional decision making. Even though it's the most prominent way that we're making decisions when not us here at Generation Capital Management, we are the eliminator of emotion. We don't act emotionally. We act based on information and logic. But individual investors, when they're making decisions, they do tend to be emotional about that. There are a couple of ways that we can, as individual investors, step away from that emotion that tends to drive our decision making. In terms of investments, we can work with someone like Generation Capital Management, with us here, to manage the portfolios. Of course, outside assets, things like joint accounts, individual accounts, IRAs, those are the types of things that we can invest on a client's behalf, and help them to remove that emotional aspect. But then in clients' 401k, 403b, anywhere that they're directing the investments, one of the things that they can potentially do to eliminate the emotional side is use things like target date funds. Those are mutual funds that are managed by a management team who are, investment professionals trying to make decisions based on a class of people, a group of people who are planning to retire at that specific retirement date. So they're taking emotion out of the process themselves and looking at the objective data that's in front of them. Some target date funds do perform a little bit differently between their peers. So it's important to do your research on those. But that's also a good option. And other than that, if there's ever a question, we're always happy to answer. And it's just really important to make sure that you're doing whatever you can to take yourself out of that emotional environment. Have a conversation with friends. If you have someone that you seek advice from, talk to them about, not just ask them for what they do, but talk to them about how the two of you together can, work through getting through those emotions and try to remove yourself from that emotional tea that we tend to make with ourselves.
Yeah, we got a question or two, but one thing I just did want to touch on before we jump on to answering the questions is, how do we manage? I mean, we're talking about, providing a lot of information. How are we looking at the markets themselves? And as we mentioned, we're a macro manager, I guess, if you look at it. We're big picture. We tend to look at things within the framework of an economic cycle, which will lead to our overall positioning. And what that means is that depending on where we are in the cycle, the economy, there's going to be certain industries or investments that are going to perform better depending on where we're at. And there's going to be certain industries that don't perform as well. So, obviously what we want to do is we want to make sure that we are allocating to the better performing investments and really taking risk off or lowering our allocations to the ones that we don't think that are going to do as well. So, the key thing for us is really trying to make sure that we know where we are within that cycle. And then and a lot of it is just filling in the blanks and putting the puzzle together with the pieces in terms of how we want to construct the portfolio. This environment right now, there are so many cross currents. We have inflation that's sticky, headline at 8.5. Core inflation, which takes out food and energy, is roughly 5.9%. I mean, we have the markets pricing in another, 1.25 rate hikes through the end of 2022. So that's 5 more moves, 5 more quarter moves. We think they're going to be doing it in a couple time frame. And then one thing I always say when we talk about in the market mashup is watch the credit markets. That's the first thing that we focus on is the credit markets. And that's the ability for people to borrow, ability for companies to borrow. And the more lower rated that you are in terms of your overall credit ratings, higher rates can have a damaging impact on your ability to refi or take out debt. And that's one thing that we focus on is checking the spreads. The Federal Reserve over the past 7 or 8 years has bailed out a lot of companies by really, buying their debt or guaranteeing their debt and making it easier for companies to refinance, and especially ones that shouldn't, should have gone bankrupt. So you've really eliminated that whole bankruptcy cycle. The dollar remains strong, which is good for some, but it's not great for our multinationals. And then our international markets are, if you think our markets are bad, international are worse because, especially Europe. Let's just take a look. You have geopolitical risks. You've got gas prices and energy prices going up crazily high because they don't have the supply. And then you also have an economic slowdown. So, you can see the markets are selling off and the consumer is feeling the pinch. They're feeling the pinch with, higher gas prices, higher food prices, higher energy prices. Just their normal way of life is going on. So what are they doing? They're taking out more debt to cover their normal expenses. Credit card debt is exploding. And at some point, you're going to have to pay that back. And with interest rates rising, your credit card rates are going to be going higher as well. So, be prudent. Be prudent in terms of your, your financial picture. Debt is easy. People can get it easily, but you still have to pay it back at some point in time.
Absolutely.
Now, one of the questions that we had, John, is from one of our LinkedIn users is how do people get started in investments? How do they start with an investment plan form? Do you want to jump in and answer that one?
Yeah, sure. So from a financial planning standpoint, it all counts on making sure that you're looking at your money the right way. Typically, I recommend anywhere, depending on your household scenario, anywhere between 3 to 12 months worth of expenses in a bank account, in just a regular checking account. So if you or your partner or someone in your household were to lose a source of income, you have that money available to you. Or if something pops up that, at home where you need a new hot water tank or a new furnace or something along those lines, we want to make sure that we at least have that liquidity available to us. Then from there, anything above 12 months of expenses, as long as we need to make sure that we don't have any big purchases coming up for which we would need a lot of cash available to us. So things like a down payment for a house, potential, a child coming into the picture, something along those lines, dynamic shifts, healthcare changes, things like that. But then beyond that, the additional kind of icing on top of the cake that we have, we can then start to look at investing. Of course, it's a very challenging environment right now to try to find return. Things are on sale. So I have been recommending people take a look at I-bonds if there's money that they know that they won't need for the next year at least. And then we can, from there, if they want to actually start getting invested, we can sit down and have a conversation about, them opening up an individual or a joint account here, starting to invest with us. Or, if there's something that they feel is a better fit for them, we might help them find that opportunity as well. Or one of the other things that I've really liked recommending lately is increasing, if a client finds that they have a large balance in their in their bank account, to start making additional contributions, increased contributions to their employer-sponsored retirement plan. Essentially taking more out of their paycheck and directing it directly to that retirement plan, and then living on the excess money that's in their bank account. And what that does is it essentially gets them invested into what's typically the lowest fee structure investment option for them, and it gives them the benefit of the tax deduction, the dollar for dollar reduction of taxable income for the contributions to their employer sponsored retirement plan. So those are kind of all of the little fingers that I typically recommend.
Yeah, and you also want to make sure that you're invested. If there's a match with your employee plan, that you're at least putting in the amount to get the full match. That's important. Absolutely. Because that's free money that you're losing out on if you're at least not making the minimum contributions to get the full match there. So great That's points right there, John. One last question that we did have was, a comment on interest rates and inflation. Why is the Fed raising interest rates to combat inflation? It's basically just if you look at it, concept of supply and demand. Right there. The Fed, there's too much demand for too little supply, and prices are going higher. So how do you eliminate that or reduce that? Well, you really want to make sure demand is lower. So you want to have more supply than demand. And what that'll do is it'll lower the price structure. So the Fed is really trying, by raising rates, to reduce the amount of demand or slack that's out there in the economy right now. There's too much liquidity out there that's still chasing goods and moving prices a lot higher. Now, what we've seen so far with the Fed raising rates is mortgage rates have gone up a lot too. Mm-hmm. Last year, you could get a 3-year or a 30-year at 3% or under. Now you're looking at 5.5 on a 30-year with good credit. So what that means, number one, is what you're able to qualify for could be a lot lower because your payments are going to be a lot higher, and it's just based off of the interest, the amount that you're going to be paying in interest. So what we're seeing in the housing market right now is really a slowdown, in terms of new home sales. There's a lot of people that were, had permits out that are now balking and backtracking out of them. And you're going to start to see prices come down. And we are seeing that right now with the numbers of homes. I think it's close to 20%. They've had to lower their price in the last month because the demand is not there. So it is, you are seeing how raising rates could have an impact on economics, people's economic conditions. And, the housing market is a prime example there. So, it's a great question. And, the hard part you're having is that, the Federal Reserve is raising rates into an economic slowdown. So usually you start to see rates being raised when the economy is continuing to stay strong. So, I truly believe the Fed missed the boat. They should have been doing this last year, and we wouldn't be in this predicament that we are right now. John, do you have any last words of wisdom or thoughts that you want to convey before we wrap up our first GenCap Power Hour?
No, not really. Just be sure to check out my ongoing YouTube series, John's Top Tips. You get to see this mustache on YouTube and giving you all the best tips that I can come up with. I scour my brain and go to town on some of the best jams that I can come up with for you. So be sure to check that out. You can check out the videos on our website. You can email me at this email address right here, jhowe@gencapmgmt.com. If you want to nerd out with me about any financial planning topics, I would be more than happy to talk to you. Or if you just want to sit down for a good old cup of coffee, reach out to me. I'm also highly addicted to coffee, so I'd love that.
Great. Thanks, John. I appreciate, John coming in and spending a little more than a half an hour, giving words of wisdom there. I want to thank everyone for joining us. Please check out GCM and continue to follow us on LinkedIn. If you want to learn more about, our work at Generation Capital, feel free to contact us, for a free consultation. You can sign up for our newsletter, visit our website, www.gencapmgmt. You can peruse our financial planning, our investment processes and philosophies, and we're happy to answer any questions that you might have. And also follow us on social media. As John mentioned, throughout the month, we have John's top tips. And every week I have my market mashup, which is just a 3 or 4 minute recap of financial markets from the previous week and what we're looking for going forward this week with any data or numbers that could have an impact on the overall markets. Please follow us, next month. We're going to have this again. Look forward to our future guests that are coming on. We will be keep checking our sites because we will be reaching out with some, great guests and timely topics that I think will be of interest to, like I said, our social media and LinkedIn community. Once again, I'm Scott Nasca, President of Generation Capital Management. Thank you for participating and watching our first GenCap Power Hour live session. Look forward to seeing you next month. Have a great month of August and happy Labor Day. And we'll look forward to seeing you later in September.